Let us move to measurement. Firstly, initial measurement. Financial instruments, except for short-term receivables and payables with no significant financing component, are initially measured at fair value and plus or minus directly attributable transaction costs for financial instruments not at fair value through surplus or deficit. If the financial instrument is carried at fair value through surplus or deficit, the transaction costs are immediately recognized in surplus or deficit. Short-term receivables and payables with no significant financing component are initially measured at their transaction price. So what is the difference when considering measurement? There are new definitions that impact measurement, credit-impaired financial asset, and credit-adjusted effective interest rate. Let us consider each in more detail. Credit-impaired financial asset. A financial asset is credit-impaired when one or more events occurred that have a detrimental effect on the estimated future cash flows. Evidence might include significant financial difficulty, a breach of contract, for example, default payments or past due event, concessions that were granted that would not be otherwise considered, the borrower enters bankruptcy, or financial reorganization or disappearance of an active market because of financial difficulties. This is when the debtor defaults on payment. This list is included in the standards of when this might happen. The principle is similar to what we currently do in GRAP 104. However, the terminology is a bit different. The term default is referred to in the standard as what the entity defines it. The entity will include this as part of its accounting policy. Example, default if it is unlikely that a debtor will pay within 30 days. Credit-adjusted effective interest rate is the rate that exactly discounts the estimated future cash payments or receipts through the expected life of the financial asset to the amortized cost of a financial asset that is purchased or originated credit-impaired financial asset. 3 types of credit-impaired financial asset. Purchased. Companies buy up bad loans at a massive discount and recover the money purchased at a deep discount. This is always credit-impaired. Originated. Entering into a transaction, you already know that they are credit-impaired. It might be in terms of legislation, for example, but this is always credit-impaired. Happened. Defaultive data during the course of the transaction. I have included 2 examples for us in the next slides. To consider the initial measurement when we look at credit-impaired financial asset. In the first example, we have an entity. They sell goods to the value of 1,000 Rand to a customer. The terms are 4 payments of 315 Rand and 47 cents per year, with interest levied at 10 cents per year. The customer is credit impaired. We can assume that in terms of the example, the entity expects to collect 200 Rand per year. At initial recognition, we need to understand that on day 1, there is a payment. How do we determine that payment? At the bottom of the slides, the calculation is included for us. We have repayments of 200 Rands per year for 4 years. 10% interest, which means the present value of future cash flows discounted back to a present value of 634 Rand. This means that although our sales are 1,000 Rand because we sold the goods, we have the customer that we debit with 634 Rand on day 1 because we have a credit-impaired financial asset with a debit to the loss allowance, or ECL, with 366 Rand. The next example, once again the recognition is looking at purchased credit-impaired, and the purchase price is 900 Rand with the remaining life of 5 years. Interest is at 10%. The remaining contractual cash flows are 1,000 Rand, and we have expected cash flows over 4 years of 250 Rand per year. The purchase price is less than the remaining contractual cash flows of 1,000 Rand, meaning we've purchased this financial asset at a deep discount. So at initial recognition, we recognize the loan at 900 Rand, which is what we paid for it. the purchase price, and we credit our bank in year 1. We calculate our interest, and this is where the credit-adjusted effective interest rate becomes applicable. We need to determine that rate. How do we determine it? Well, we have our number of payments, which is 4 years. Our payment per year over the next 4 years that's expected is 250 Rand per year. The present value is 900 Rand because that is what we paid for it today. The future value is 0 and the type is 0 because it is not paid in advance. It is paid in arrears. That is an assumption that we make, and we calculate our interest as 4.35%. That interest is what we use to determine year 1's interest. If we go back, our interest is calculated as 900 Rand times 4.35%, which is our credit-adjusted effective interest rate, which means we debit our loan with the interest of 39 and we credit interest income with 39, which brings us to our year 1 closing balance. Our initial 900 Rand plus 39 Rand interest we expected, and let's assume we receive 250 Rand payment, which means our balance remaining as closing balance is 689 Rand. It is assumed then, at the end of year 1, our position of our expectation of what we are going to collect as cash flow has improved, and for years 2, 3 and 4, we expect to collect 270 Rand and no longer just 250 Rand. At the end of year 1, we now need to determine our loss allowance, which means that we consider our number of payments remaining over 3 years, which is 270 Rand per year, and we now have our credit-adjusted effective interest rate, which we are going to use to determine the present value of our future expected cash flows. And our present value is 744 Rand, which means that we had a closing balance of 689 Rand. Our present value is now 744 Rand, which means that we have an impairment increase. So we debit our loss allowance and credit impairment gain. In year 2, we calculate the interest, still using the credit-adjusted effective rate because we still have a credit-impaired financial asset. The classification did not change, and we calculate our interest income based on 744 Rand, which was the present value of our future expected cash flows at the end of year 1, which is based on our 270 Rand being expected to collect over the next 3 years. If we then move to subsequent measurement, our categories are similar to the current or existing GRAP 104 standard, which are fair value through surplus and deficit, amortized cost, and cost. As I said, you need to consider the classification criteria when you start preparing or already preparing for implementation of GRAP 104 revised. You cannot assume that the classification is automatically the same. You have to go through a process to say, these are my instruments, let me look at the classification criteria and ensure that I have applied them correctly or that I have confirmed the classification is still the same.